Hey guys, Killstokes here. Welcome back to the channel. In today's video, I'm going to walk you through a classic loss of momentum and reversal pattern in the market called a rising wedge. And of course, I'm just not going to show you the pattern. I'm going to take you through the entire analysis of breaking down why this particular one stood out to me, and then walking you through the three areas that we need to focus on before we ever take a trade: entries, stops, and targets. And of course, at the very end, I have a very important lesson for you as well. So make sure you don't miss out on that. All right, let's hop in. All right, so let's do some IPDE here. We're gonna use the 4 hour and the hourly. So let's identify. What do you identify here on the 4 hour? What is price doing? Where is price at? What is price done? How would you classify this? I can zoom out for you a little bit too. So price has recently broken and closed above a previous level of structure, retraced off of it, and now we are working on extending up, and we have come back to our previous structure high, our most recent structure high, and currently we are holding. Now, as I think it was Muse mentioned, we can see that price action is creating equal highs. Anything here with our indicator? We've got a little bit of divergence, would you say? A little tad bit of divergence. Now, this is the interesting thing. This is where you can start getting like false signals and really confusing yourself as well, where you're like, okay, but Akil, wait a minute. We've got higher lows here, and we've got, oh my gosh, what is this? What is this called? At the bottom. Hidden divergence, and that is a sign, a good sign for bulls, continuation, right? Oh my gosh, at the top, we have regular divergence. That is a good sign for bears, counter trend. Splat, right? That's your brain exploding, and the splat is it hitting the desk, right? Very easy to confuse yourself with different signals. This is why you need to have rules on, obviously, how to establish your directional bias. But this is why you also want to focus on one side of the market at a time, right? You need to decide at this point whether you are looking for a counter trend trade entry, bear, or a trend continuation entry, bull. If you are trying to do both, you're going to start seeing things from both sides of the market, and it's going to be very easy to get confused. So you want to establish your directional bias. We call it a confirmation bias. And then you want to look for the reasons that only support that directional bias. So if you are looking to be a breakout trader, right, you're saying, hey, you know what? Price action broke and closed, a bullish breakout trader. You're saying, hey, price action broke and closed above previous structure. That puts us in that continuation state. We pulled back, which is exactly what we're supposed to do. We got hidden divergence, which is good for bulls. And now we're retesting the highs, and we're ready to extend further. Right? So you're looking at that bullish bias saying, okay, this is what supports my bullish bias as a continuation trader or as someone looking for a bullish breakout. If you are a counter trend trader looking for shorts, your narrative is a little bit different. You're saying, hey, price action came to this level. We pivoted off of it. We retraced. We came back again. If we can hold this level, I'm looking for shorts. We also have bearish divergence up there that supports that. So you got to decide one or the other, because if you get caught up in, and so many traders do this, and it's natural, right? Doesn't mean you should do it, but it's natural. I think this is one of the things that one of our traders I'm talking to recently is going through, because he's been studying everything in the course, but he hasn't decided what he wants to do within the course yet. So he sees everything. And that's the whole paralysis analysis thing, where it's like, I see this, I see that, I see this, I see that, yeah, and then you freeze. So you got to understand what type of trader you are and what type of clues you're looking for based on your trading style. There's some questions that came in real quick on this topic. It's a good one. Hidden divergence. Ali said, would you say, Hakil, that's right to say to use only indicators when they are confirming your set? Oh, look at that. Perfect. Yeah. You know me so well, right? He wrote that question before my rant went off and I already got it. Yeah. Now, yes. Now, you also want to be careful that you're not creating... So, are you guys familiar with the term confirmation bias? It's a double-edged sword, right? Because there's a W in sword for some reason, right? Confirmation bias is pretty much you having an opinion on something, and then you only give energy to the things that support your opinion. So in the market, we do the same thing, right? I used to get in trouble with this as an investor because when I was a really young investor, I didn't really know anything about the markets. So I just had an office. I had like 3 TVs in my office, and I would just watch all the pundits talk. And when the pundits, so say I come in on a day and like CNBC, turn it on, right? Squawk on the street. It's like, hey, buy silver, buy silver, buy silver. Then I head over to Bloomberg. Hey, here's why we got to buy silver. Got to buy silver. All-time high. Got to buy silver. Then I go over to Reuters or something like that, read an article. Hey, 5 reasons you should buy silver. I did this as all of my prep before the markets open because in the stock market there's a set opening bell, whatever like that. And guess what I was looking to do whenever I would open a chart on silver? I was looking to buy. Why? Not because of my own opinion, but simply because I was convinced and brainwashed by what everyone else said. Everyone else that I valued said buy silver. So when I would look at a silver chart, it could be the most bearish signal in the world, but I was only looking to buy because my bias was had to buy, had to buy, had to buy. So that's a negative version of confirmation bias where you're influenced by outside parties. The positive version is the one that we create ourselves. This is that whole IPDE. We do that identify, predict, decide, execute, right? 4-step process, because when we identify and decide, we are creating our confirmation bias. But we're not doing it because of what someone said. You're not even doing it because what myself or Jason said. You're doing it because you're reading the chart. And based off what you read on chart, rules based, you're deciding what direction you should be in. So at this point, you know whether you're bullish or bearish. Then when you go down to the next, this would be predict. Sorry, guys. I'm still thinking about the Arun indicator, right? Identify, predict. This is where you form your confirmation bias. Then once you've formed your confirmation bias and you're locked into your direction, now you're looking for a reason that you can actually get in the trade. So we want to do it that way versus using, I think, I'll say you want to be careful just not to use an indicator to form that bias for you, unless the indicator is part of your INP. So, for example, we talked about, what was it, the ADX earlier, or let's just use a moving average, right? If your trading rules say, hey, I use a 2 moving average cross to identify my directional bias in the market. Well, now, right, you load up your moving averages. If 20 is above 50, if I identified 20 being above 50, right, then I've identified bullish trade or bullish trend. Therefore, I only want to be bullish. So this would be a rules-based way of using an indicator to do this IPDE. So you can do it both ways, but you have to be it has to be rules-based about what you're using to create your directional bias in the market. You just can't feel one way and feel another thing, right? It has to be rules-based. It has to be rules-based. That's the only way it's going to be consistent. You know the formula: consistent analysis plus consistent execution equals consistent results. And Devin's got a prop firm question. We'll save that for later. Peter says, doesn't structure take priority? It takes priority for me, Peter, but I'm a counter trend based trader, right? So for me, when I see price action at a level of structure, my counter trend brain says, I always expect structure to hold until I'm told otherwise. And what would be a technical reason of, excuse me, until I'm told otherwise? What would you guys say? What would be a rules-based technical reason of until I'm told otherwise? Yeah, a break and close above. So if we were to get a higher high, higher close, then I'm like, nope, not counter trend anymore, because higher high, higher close above a decision point means trend continuation. So now my bias would shift to bullish that quickly. I'm a mercenary, right? But if I were to put myself in the brain of a trend continuation trader, trend continuation traders tend to think the opposite, right? You may not, as a trend trader, and again, you don't have to be like this, but let's say you're a heavily trend trading person. Your expectation is not necessarily that, hey, price will hold this level. Your expectation may be that price is likely to break through that level, right? Because you're expecting, as a trend trader, right, these these highs to be broken. That was embarrassing. To continue your trend. Does that make sense? A counter trend trader would expect these to hold until told otherwise. A trend continuation trader would expect these to be broken. So this is when we talk about discovering your trading philosophy and personality. This is why it's important to understand where you stand, because now not only can you have a clear set of rules, but you can have a belief in those clear sets of rules. This is also why it's okay for two traders to look at the same chart and have different opinions. So yeah, something to think about as you continue on your trading journey. Where do you land on your belief about the market? Do you believe that structure is more likely to be broken than not? Or do you believe that structure is more likely to hold until told otherwise? And that will tell you a lot about your trading personality. So anyway, so we're here, and then Muse wanted to go down to the lower time frame. I think if I remember the original question, which we talked about a million years ago, let me just scroll back up and see. Watching cricket. All right, RSI overbought divergence. Lower time frame, 1 hour high test candle, followed by lower low, lower close. So the high test candle that Muse is looking at is right here. These are some good looking candles, right? If we understand the stories that candles tell us, when we get a high test to the upside and we don't end up breaking and closing above, is that a sign of bullish strength or bearish strength? What would you guys say? Bearish strength. I would also say there's one more thing here too that wasn't mentioned. I want you guys to see if you can identify it. I'm gonna cheat a little bit. There may be two things here actually. I'm gonna cheat a little bit. You guys see it? Come on, I want to tell you, but I can't. I want to tell you, but I can't. Yeah, look at that. Rising wedge. And this is a what type of pattern? Not a 3-bar reversal, though. We don't have a 3-bar reversal. Close. It's technically 4 bars. This is a loss of momentum pattern, a relief pattern. So we can add that to our equation. We have price coming from a strong directional move. And then we have a loss of momentum pattern heading right to a level of structure. I always talk about how these are tricky to trade, right? Because you never know how high these things are likely to go. This one would be very easy because you know where stops will go, right? Where are you wrong? Where are you wrong in this trade? If you're looking for a bearish trade, yeah, you're wrong if price breaks above structure. So that's where your stop loss goes, right above structure. Obviously, you want to do your rules. I didn't do the math, whatever like that, but you guys get the point. So this one's kind of easy. So I actually like this one, Muse. Despite us having a green candle right now, I like this. Rising wedge into a previous level of structure. We have nice kind of indecision and high test candles here. And then we put a sprinkle, a cherry on top. There we go. I don't like cherries on my cupcake. I don't like sprinkles either. I like a good old plain cupcake, right? Here's a good entry reason for you right here. Lower low, lower close. Now I know what you're saying, Akil. There's a green candle next to it. This was still a good entry, right? Don't let hindsight confuse you. If you're looking at this real time, this is a hell of an entry right here. So we got that. Let's work the best of the rest of this trade. Again, just focusing on orders. So if you were to enter at this lower low, lower close candle, what type of order would you use? And Devin, this is one where you put in the CCI or the ADX and see if it gives you any confirmation, see if it helps at all with this. That's what you want to do with indicators when you're experimenting with them, right? Again, if you're using them as support, put them on your chart and see if they support the price action based thing that you're seeing, and it could give you a good idea of like, hey, I think I can use this in conjunction, or like, I don't know, right? All right, so what type of order would this be? If I'm putting an order right here, like in order to get into the trade. Nope, not a sell limit, not a sell stop. I want to get involved right after this red candle. As soon as I see that lower low, lower close, I want to get involved in trade. Yep, at market. At market sell, right? So remember, the limit orders are orders that are going to be limits and stops are going to be on in advance. At market, meaning it's a real-time order. So this would be an at market sell right at the end of this green candle. I want to get this into our pro trade log real quick before we finish it. But the next thing we want to do is we want to look for stops. Real quick, let me just get this in. This is Canada yen, 1 hour, potential rising channel, rising wedge. Same thing, doesn't matter, keel. Wedge into structure, bearish, there we go, in there. Sorry for the clickety clacking. You guys are used to it by now. Here we go. Bang. That's in, oh no, that's in there. All right, so next, stop loss, right? You guys want to use ATRs, you want to use something else? Hit me with some stop loss ideas. And I'm going to throw in the CCI or the ADX to see if it gives us anything. It's just consolidating as we would expect. While you guys hit me with some stop ideas. Hit me with your best stop. Ooh, that was good. I wanna know. That was a good one, right? Hit me with your best stop. Boom, boom, boom. No takers on that. All right, I won't quit my day job then. All right, back to trading since this music career isn't working out for me. ATR, right? So let's use an ATR based stop. Let's go over, see what our ATR is. We can actually use either our previous candle or our entry candle. ATR is 9. So we find the highs right here. 116.61 plus 9 is 116.70. Sorry, I'm going to get this away from here. 116.70 would be a 1 ATR stop. A 2 ATR stop would be 79. So here's your kind of your looks at your stop zone. Real quick, what type of order, as we go on our theme, would be here? Can I book you for you? You couldn't afford me. Am I gonna get sued? Aren't you not allowed to sing like music and songs? No, you can't play songs on. I changed the words. It's fine. Okay, I don't want to get sued for like copyright infringement. Yep, buy stop, right? So your sell market, this would be a buy stop. Correct. Bang. There we go. Perfect. I wish this was a pair I traded, guys. I like this opportunity. Now, the magic question. This is the hardest part. This was the easy part, if you could imagine. Entry is easy, rules-based. Stops, easy, rules-based. Targets. This is where, in many cases, it's a little more discretionary if you have the freedom to pick where you think the market's going to go. This is the tough part. Where do we think price is going to go? If price is likely to go lower, where do we believe that price is likely to go? And obviously, we're a little late here, but this is stuff you would do before you enter the trade. You don't want to be in a trade and be like, okay, wonder where we're going now. That's not a good idea. What do you think target-wise? I've got a few ideas. It's going to take some analysis. Obviously, I would aim for the beginning of the channel. Is that going to put us right here? About 116 quarter. 116 quarter, okay. 116.25. There we go. Anyone else? Mo says I agree. Phil says 116.10. I see your 116 quarter and lower you 116.10. 116.10. All right. Reason for 116.10, Phil? I think I know, but I want to hear you. I want to hear you say it. Noel says same as Ollie, but we're throwing some volume to confirm it. Okay, we can throw that in. Muse says, we'll look at volume, even handle number structure, level support. Phil's looking at inside support right here. Or just let's just measure out this whole zone. I like it. All right. We can bring some fibs on, right? Fibonacci retracement. Swing low to swing high up here. Look at that. We got a 382 right at Phil's level. Take that, Ollie. You guys want to see volume as well. Let's bring on some volume profile. See what we have here. All right. We got a high amount of volume here where we're currently consolidating. No surprise. We got a little bit of a void, small spike right here. Then the bigger level is right around here, right around that 382. So the 116.10 has the highest volume. We do have a little bit of spike and structure here at 116.25. So I like both those levels. I like both those levels for you guys, but I think one may offer an opportunity and one may not. Now, you don't want to make your decision off of this. Here, that's the key. I see this so many times where it's like, okay, stop loss or entry, bang, stop, boom, target. Oh man, it's less than 1-to-1. And then they're like, well, you know what? Actually, if I stretched it down here, I could make it work. No, you can't do that. You can't do that. Well, you can. Technically, you can do whatever the hell you want. You shouldn't do that, right? Should you change your target to make the trade work? No, right? Because here's the thing. If you truly believe that price was going to go to that level, and by believe, I mean your analysis believed it, that would have been your level in the first place, would it not? If you felt strongly about that level, that would have been your level in the first place. It's kind of like when you have like a girl you're interested in, and she likes your friend, and then she finds out that your friend doesn't like her, and then she's like, okay, I guess I like you now. No. If you really liked me, you would have liked me first. In this example that I'm taking completely random and certainly wasn't something that happened in my personal life. Yeah. So no, you I don't want to say cannot, you should not do this. You should never adjust your trade to make it work. And that goes the same thing for stops. So you should not be like, well, you know what? I'm going to put a stop loss a little bit lower to make it work. No, right? Your stops are at a very specific location for a very specific reason. If you move your stops to a level that doesn't give you the safety and the proof that you're wrong, then you could be out of a trade and still be right. And you don't want to do that. So, unfortunately, if you're someone looking for this shorter level, and someone said the question, Mo said, what about the 1-to-1 risk reward rule? What about it, Mo? You tell me. What about it? Tell me about it. What's on your mind about it? Talk to me. Put your feet up on my couch and talk to me about it. What about this 1-to-1? What concerns do you have? Let's put you on the trading couch. That's a cool name for a podcast, the trading couch. Mo is saying, well, we don't have a 1-to-1 risk reward. Yup. If our rules say we require a 1-to-1 risk reward, if we do not get that 1-to-1 risk reward, however close this may be, then you don't take the trade. Now, I do have a possible solution for you, which let's hold on for a little bit with that, but you don't take the trade. So this one just sucks, right? And I tell you, a lot of the time in the market, for you guys that are new, we do a lot of analysis. Very rarely do you get a trading opportunity because either the stop doesn't work, the target doesn't work, the risk reward doesn't work, or you just don't get the reason for entry. So this is one where it's like, man, everything lined up except for the risk reward. Ah, man. And that's just part of trading. And the difference between the successful trader and the struggling trader is the successful trader, okay, right click, delete, or looks for a secondary opportunity. The struggling trader looks to the left, looks to the right, and then takes the trade anyway. The successful trader knows that, hey, okay, this one doesn't work. This opportunity doesn't work out for me. But you know what? There's another one that will. I'll just wait for that next one. So other way around, if you're looking for those looking for the lower level, the fill level, right? Easy risk reward. Boom. No problem. You can even go for that deeper stop loss and still be good. Sean says, but wouldn't we want to go for target 2 anyway since it has the higher volume? Not necessarily. It's all based on your analysis and where you believe price is likely to go. So if your analysis says, hey, I think price is likely to go to that level with the higher volume, then yes, that's the level for you. If your analysis says, hey, I think price is likely to go to the beginning of the first retracement in the wedge pattern, which does have a little bit of a spike, not a big one at all, then this is the level for you. Yep. So it all depends on the trader and what they believe. And again, belief comes from analysis, what and where they believe price is likely to go. And that's going to be different per person because everyone values different things, right? Some people value volume as the number one thing. Other people value fibs. Other people value structure, right? Or other indicators. So it all depends on what you value. And that's the discretionary part of trading. Now, the one thing you can do to get involved here, and I don't have this in my rules personally, what do you think it might be? I can't get I don't have a good risk reward to this first level. What would be another way to get involved? I see people typing, so nope, not lower time frame entry because the entry needs to be on the hourly per the rules. So we don't want to break our rules and deviate from that by going to a different time frame. But what else? Wait for a new candle. You could, if you have a backup reason for entry, you may not have that here because you're not going to get a double top here. But you could, and again, I don't do this. You could say, hey, instead of entering at market here, I'm going to put a sell limit order at the price point that gives me a 1-to-1. And if price retraces to that level, then I'll be filled at that price that allows me to have the 1-to-1. Does that make sense, guys? Now, the problem with that, and this is why I don't do this, is candles give clues. So, for example, if this candle breaks and closes above here, that is a completely different sign than what I got here. This is a positive sign for bears. This is a very negative sign for bears if it were to break and close above. And now you're aggressively involved in a trade where you have a negative signal. So there's different. You can justify it though. You can say that, well, Akil, that candle would have happened regardless, even if I were in the original entry. But you also weren't in the original entry. So this is why it's a little bit iffy. It's not a personal preference of me. I don't do it. I guess the middle ground too would be you can wait for the candle close, perhaps. For me, I would need to see an entirely new entry signal personally, but that is a way that you can get into a trade late if you needed to. Either put a sell limit at the price point that would give you that risk reward of your favor, or wait for the entire close of that candle. And if that next close closes within a zone that gives you a positive risk reward and obviously doesn't violate the trade, then enter next bar market after that. That could be another reason. Or in the case of this, maybe you get another lower close. Who knows? But I did want to throw that out there because again, it's not just about how I trade, but just giving you guys different options and how you could trade. So, Mo, this was a fantastic example. I wonder if the range bar charts. This probably would have looked good in the range bar chart too. This is it's only a 10, real quick. And we're probably gonna go straight through today. No break. Canada yen. Right out. This was our rising. This was our rising channel from yesterday. Rising wedge from yesterday. Looks like it failed miserably. Yeah, we went straight up. Let's see what right at structure. I was gonna say let's see if we can get a continuation to the upside, but we're at the upside, so no. Just a miserable failure. That 1-to-1 rule would have saved from a loser. Yeah, that's a really good point. That is a really good point. What was that? Canada yen. It's the small things sometimes, yeah. I hope you enjoyed the analysis, and before we hop into the lesson, just want to remind you guys that footage was from our live trading room. If you ever want to hop in and join us, either the New York session with myself or the London session with Jason Greystone, or both, you can do so as part of your risk-free trial membership. Just head over to www.tier1trading.com and sign up. You get 14 days on the platform. You get to join the community, talk to the gang, join us in our live sessions, and there's no sneaky auto bill or anything like that. After 14 days is up, you just lose access and you can't log in. So you can put all those worries of fraudulent scamminess to the side. Again, www.tier1trading.com. Check it out. So recently we've been having a lot of conversations about sabotage in trading. And I'm not sure when this video is going to come out to you guys, so there may be a podcast episode released on this already. But we've been talking a lot about how trading is simple, but as traders and as human beings, we tend to step on our own feet. We tend to trip ourselves up and not do the things that we are supposed to do. And this trade was a perfect example of that. So from a technical perspective, the initial analysis lined up good. We had the pattern formation that we wanted. We had it at the location that we wanted. And when we went through that three-step process, right, developing our EST, entry, stops, and targets, that all actually worked out well as well. Except for one thing. If you remember, the initial target area did not give us our minimum one-to-one risk-reward requirement. And that's the thing. You can have everything correct in a trade, but if one thing doesn't meet your rule and you take said trade, it's going to be a bad trade. And although the risk-reward ratio had nothing to do with this trade winning or losing, we could have easily had a great risk-reward ratio and it still would have lost. The point is, it is small things like this that sabotage your trading. It's the small fact that, hey, if you decided to take this trade knowing that it didn't meet your rules, you now took on an extra loser. And now to make up for that extra loser, you're going to have an extra winner. And you may be saying, Akil, so what's the big deal about that? I lost, so I just have to win again. Well, instead of that winner putting you more into the profit, so pushing you in that positive direction, it's simply just getting you back to break even or putting you in less profit than what you would have. And the thing is, it doesn't seem like a big deal. And it isn't a big deal on a single trade, right? No one trade, winner, loser, whatever, makes any difference in your performance. But the problem is, this type of error isn't usually a one-off error. This is an error that traders make repeatedly, over and over and over again. And when you keep making that mistake, it compounds, and those losses compound into bigger drawdowns. Those lack of winners putting you in profit compound to a flatter equity curve. And this is all directly related to you not seeing success in trading. I always show you that pyramid by Mark Douglas where there's the three tiers of traders. There's the successful traders. There are the losing traders, for lack of a better term, at the bottom. And then in the middle, there are those boomer busters. The successful traders are the ones that are doing the things that they're supposed to do. They're following their game plan. They're not sabotaging themselves. They're just doing the things that they're supposed to do, right? Boring trading. The failure traders at the bottom, they're doing all the wild stuff. They probably shouldn't be trading in the first place. They're losing money right away. They don't even have a plan. They're just throwing it and setting it on fire. But it's the boomer busters in the middle. Those are the ones that are making these type of mistakes. Those are the ones that know what they should be doing as traders. These are the ones that have a plan and it has a positive expectancy, meaning that they have an edge in the market. However, every time they do a little good, they followed it up by doing a little bit bad. And then they do a little bit more good, but then they do some bad, and they just kind of end up right in the middle. Now, I would say that most of the traders watching this channel are probably somewhere in this category. So if this is something that you see yourself doing, and you got to be honest, you got to go through your journaling and look at the mistakes that you're making, this one difference, simply strictly sticking to your plan and not taking the things that you're not supposed to take, could be the difference between you being at break even and being in profit. So I hope you enjoyed the analysis. I hope you enjoyed the lesson. If you did, do me a favor, hit that like button. Make sure you subscribe as well. All types of cool content here on the YouTube channel, updated daily. And until next time, plan your trade your plan. And hey, if you want to join us in the live room and hang out with traders on a daily basis, get over to www.tier1trading.com. Join the fun.